Welcome to the VSA Capital Tech and Transitional Energy Podcast. And we're back. We've had Easter. We've all eaten our Easter eggs. We've all put on weight, probably. Well, I don't know if I have. But I did eat quite a lot of chocolate. We've all had a little bit of time off. We've all had a bit of a break, I think. And here we are again, aren't we, Phil?
We are, but it was a very nice holiday, and we got some good weather as well, which was great.
Yep. Now, I mean, the world's still pretty balmy out there. We've seen gold hit 3,500. It's come off the top, but that's nothing goes up in a straight line. So the trade wars sort of still take place. I suspect that there's a few people starting to tap Donald Trump on the shoulder and just say, mate, you need to calm this down a little bit. You're really damaging America. The big CEOs of the banks, the big corporations, actually some of the Republicans themselves probably going, this is getting a little bit dangerous, Donald. You need to calm down a little bit. So my view at the moment is the world probably will calm down a bit. I think they've come out with a sort of wham, bam, thank you, man type attitude. It's not really working. And it's often amazing how the powers that be aren't always the people you think. We all know that, for instance, the bond market is incredibly powerful and sometimes stops people from doing things. Could be the case in America. Anyway, turning to tech and transitional energy, the bit that caught my eye over Easter, actually, Phil, I don't know if you read this, it was all in the FT, actually, and that is that CATL, the big Chinese battery company, is come out with some amazing battery, all right? It's Shenzhen battery cell, and it's saying it could do 520 kilometers with a 5-minute charge time, which, if you think about it, is phenomenal.
It's a massive step forward in performance, and they're using a new type of battery cell in there as well. I think it's 300 ampere hour cells that they've packed in there, but it ultimately will be a game changer, won't it, Andrew? This longer term trend to very, very fast charging, trying to get to the equivalent of the petrol pump in terms of convenience.
Yeah, I mean, we've been saying this for ages that the EV revolution is going to happen because the cars will become so good. And, they're also talking about the second generation of Shenzhen battery, which will have a range of 800 kilometers. I mean, frankly, you can go to Cornwall and back on that on one charge. I mean, what's the worry? And that says it'll be able to charge at a rate of 2.5 kilometers per second.
Yeah, that's right.
Battery technology is also just going to get better and better and better. And the cost of these cars is going to get cheaper and cheaper and cheaper. We know that because we've seen what the Chinese have done with like solar panels and things. They just get cheaper and cheaper and cheaper. So I think that people who think this EV revolution isn't going to happen need to wake up. It is going to happen. You will have a car that can go easily, 500 kilometers, charge in 5 minutes, cost you £10,000 only or something, and that's fine. That's the future. It will happen. So I found that pretty interesting reading. I was on transitional energy. I was down in Cornwall this weekend over the whole of Easter and played a lot of golf with my son, who runs the Schroders Global Energy Transition Fund. And it's always quite interesting talking to him because he's right there at the coalface watching things go up and down. And it's all been pretty much down. He's had a lot of redemptions. But you know what? I can't help but feel that right now, I mean, transitional energy, everybody just hates it. All the money's gone out of it. But it's happening. So there's probably an incredibly good buying opportunity. And I strangely, I thought, I wonder if I should put more money into his fund because everyone is so negative on it, but it's happening. And it's just like the internet crash after 2000, the dot-com bubble when it burst. Everything went round in favor. But of course, then out of that grew, the Magnificent Seven. And I think you're going to see the same in transitional energy. I really do. Obviously, it doesn't help that equities have become so, or de-equitization has taken such a grip globally that everything is down the pan. I mean, we do a lot in mining industry, of course, and gold and gold equities are completely disconnected. And of course, what we say is, well, every bloody gold company in the world should go private at the moment because with the gold price where it is, the equity price is just ludicrous. Now, of course, talking of going private, and I think this was a really interesting move in general, shall we say, and I'm sure you're going to talk about it, Phil, but let's talk about it now. And that, of course, is what PodPoint announced this morning.
Yeah. Oh.
Because it sort of ties in with everything that I sort of been saying. If your equity valuation just isn't going to be there because the market just can't see the wood from the trees, or just isn't the pools of capital to put it in the right place, you tell us, Phil, what did they announce this morning?
Well, the first PodPoint ticker is PODP, and this is one of the UK's larger EV charging providers, particularly for domestic markets as well as business. And PodPoint's major shareholder up until this point is EDF, the utility. They have 53% shareholding in the company. Now, PodPoint's share price, I was just going on screen earlier, was at a year high of 25.2 pence. And it hit a year low on the 17th of April, a few days ago, at 4.6 pence. And it had a trading update, badly received, etc. And they're seeing a lot of competition in the UK market. Nonetheless, this morning, EDF has obviously knows the company very well. It's a 53% shareholder. PodPoint's announced it's received a non-binding conditional proposal from EDF Energy to acquire the entire issued share capital of PodPoint that it does not already own, and for a price of 6.5 pence per share. So there we go.
Let's put this all into perspective. I can't remember exactly what it floated at, but I think it started trading at 250p. Maybe it floated at 200p. I know it peaked at 275p, and here we are at 6p. And, that business has not really changed since it floated. And it was just a case of, it was a transitional energy bubble which burst and has subsequently collapsed to levels that, if you're going to be successful, are ludicrously low. PodPoint and EDF obviously think it is going to be successful. No reason why it shouldn't be. So what else is there in the sector? Well, we know that the other stocks in the sector, a lot of them we like, one in particular we act for. I really feel that, when you see this sort of thing happening, that's when you start to say, actually, you know what? The markets aren't functioning correctly, but let's go private. Buy the shareholders out if they're not prepared to value us correctly. You can sort of understand why people are doing it. I do prefer it when people at least buy you out rather than just delisting. I don't like companies where they've raised a lot of money on the market, seen the share price collapse, and then delist, because that's effectively stealing money from shareholders, which is not a good thing to do. And anybody doing that, will never be forgiven. It means you'll never be able to actually, well, really, frankly, do anything in the future in terms of fundraising. Because you've effectively stolen money off investors. Sorry, that was a bit of a slip in there of my views on that one, wasn't it, Phil? I'll go no further and get myself into trouble. Exactly. Some people listening may know exactly what I'm talking about. There you
go. What does he say, Andrew? Moving on swiftly.
Come on.
Sticking with the sector, though, ITM Power.
Yeah.
Ticker is ITM. The market cap is £205 million, and so they're a very big electrolyzer developer and producer. And so this is for producing hydrogen from renewable energy. And ITM came out with positive changes to its full-year guidance. So this is an upgrade. And they said that their full-year revenues, expect to be between 25.5 million and 26.5 million pounds, and it's a 30% increase.
Still losing money though.
We'll get onto that.
All right, go on then, keep going.
This is due to increased demand, quite clearly from its customers, and they've said that it's been a net cash generative in the second half of its full year 25, and expects to end with closing cash of between £204 million and £205 million, an increase it's a slight increase to its previous cash balance of £203 million, but nonetheless cash generative, and it's upped its guidance on its end cash position for a full period. So there we are. But its overall loss guidance is unchanged at 32 million. You're right, it is loss making. But I think the key thing here is that demand is increasing, but also the cash generation for the business.
I mean, in general, as we know, there's been a little bit of as well as a transitional energy bubble, we had a bit of a hydrogen bubble. Every government in the world was saying, we're going to go hydrogen. Ed Miliband probably said it because he spouts a load of rubbish, doesn't he? But hydrogen is having a little bit of a bubble back again, maybe. ITM Power, obviously, with electrons. Interesting, Ceres, of course, the two are often looked at together. They obviously had a Bosch, unfortunately, pull out from their business. So they're off 70% this year. ITM Power now only off 8% this year. It's it shows how you've got to pick the right stock, doesn't it?
Yes.
So a difference there. And of course, the other one in the UK market that is in this space and is interesting because it's membrane free is CPH2. They're not recovering at the moment. They're the smallest of them all, but just a very interesting technology. We've obviously had a good look at it, and we were interested. But it is a tough space. Obviously, we all know that developing these new, be it electrolyzers, hydrolyzers, whatever you want to call them, or any form of battery, is very expensive. It's hundreds of millions. So you do have to be careful on that basis. But yeah, ITM was there. Very good.
Yeah. We also saw Gelion, GLN.
Well, here we go. Batteries are just in there. I think this was a raindrop rather than an ocean. But yeah,
sticking with battery technology. The market cap £17 million. Their shares are up 14% in the past month. They're developing lithium sulfur and zinc-based battery tech. And this is aiming at its transport stationary applications. But they'd announced a materials testing agreement with a tier one battery manufacturer, something they'd previously announced, but they've obviously moving that forward in terms of the technology development, and they undertook a placing, raising £2.6 million at 9p a share, and I think the shares currently are 11.65p.
They are. You're absolutely correct. Look, I mean, I actually, funny enough, I do quite like the technology that Gelion have got, but a couple of $1 million just goes nowhere in this industry. That's the problem, Phil. You need to put some noughts on the end. But yeah, they've got some interesting technology.
Yeah.
They're off for what it's worth, 32% so far this year. It's tough out there.
It is. Now, onto bigger things, but sticking with tech, and this is something, this is a company that's in a lot of UK funds, and it's a large cap. It's RELEX, formerly Reed Elsevier, many years ago, and then it's now it's very much a data services analytics technology company. Market cap $3 billion. They had a year-end trading update, and their shares are up by 19.7% this year. And if you look, Andrew, at the longer-term share, this is one that's just continued to run, and not surprisingly, it's popular with the funds. I mean, their analytics and decision-making tools in software are used across fraud and risk management, scientific and technical. They're involved in as well. And they said that just looking at their guidance, they said in the risk management group, which is 34% of group sales, they're seeing continued strong revenue growth, and particularly driven by financial crime compliance. Oh my God, there's enough of that about digital fraud and identity. They're also seeing continued growth, which is interesting actually, in scientific, technical, and medical, because on the medical side, just generally looking across the medical industry, we've seen some weaker results, but they're doing very, very well in terms of product demand. And their full-year outlook is unchanged. Positive momentum across the group. So it all looks very good for RELEX.
Yep, quality company.
Yep. Another quality company, but one that really has been on the turn is Babcock, one of our larger engineering businesses, obviously exposed to defence. And they're expecting their full year 25 operating profit to jump by 17% to £363 million, beating market estimates. Strong performance across divisions, and obviously, Babcock is involved in in naval. This is warships, but also weapons handling systems. And clearly, Navy defence is a big driver for technology as a whole anyway. So that was with Babcock. And with any of these defence companies, you're always looking at their order, contracted backlog going forward. And their backlog was £10.1 billion at the end of March, up from 9.5 in September end. So that was good. Sticking with defense, but also communications, and this is specifically on technologies, and this is electronics amplifier technology. One we've talked about a lot is Filtronic, and a small cap that's performed extremely well in the last couple of years, particularly driven by its success in providing amplifiers for ground stations for SATCOMs for Elon Musk's Starlink network. And in fact, Starlink is a strategic investor in Filtronic, as well as driving demand for Filtronic's amplifier tech. But Filtronic's exposed to, it's not just aerospace SATCOMs, but also defense and electronic warfare. They've announced that they have got a new contract developing technology, again in satellite communications, and this is for the European Space Agency and Viasat's direct-to-device initiative. I mean, what this is it's 5G non-terrestrial services. It's a handheld device, for comms via satellite, and they've got a development contract there. What was quite interesting about this one is that the tech contract is for support of uplink and downlink. So I think it's being used on the satellites as well as on the ground stations as well. So that was for Filtronic. Just moving on and shuffling my papers.
One interesting point out of that, Phil, actually, is that the big companies in the UK are actually all performing, pretty well at the moment, aren't they?
Yeah.
The smaller ones are struggling a little bit, mainly because they're struggling to get access to capital, and small companies need capital to grow. It's a basic principle of sort of economics, if you see what I mean. And that's the difference. The big companies have got plenty of capital, and so they're growing phenomenally. Now, the problem is obviously we can't fund the small ones because the pools of capital just aren't there. What we need actually is the big companies to go, you know what, actually we can take on that role and we can accelerate the growth for some of these smaller companies, which we need now to help. Now, it may be they go, yeah, but we don't want to go and buy that. We don't do that. They actually need, and a lot of them have got little venture capital arms anyway. They need to be a bit more ballsy, I think, and recycle some of the money. We obviously saw it when we brought in Caterpillar into Equipmake. There was a classic case of, why did big global Caterpillar put 5 million into Equipmake? Now, obviously, we probably know more than the answer that's sort of out there, shall we say. But the bottom line was that, Caterpillar's business model going forward actually needed Equipmake to survive. They needed that technology. Equipmake have some very specific, very smart technology, which is just not understood. Actually, I think it is understood by the market, but no one's got money to put into it. It's not that they don't understand it, they just don't have the money. They can't support it. And so Caterpillar said, yeah, okay, actually, we've got to support it because we need it for our business strategy, our global business strategy. And what we need to see is more of this. And actually, in fairness, we are as a firm doing more of this now, going out to the big global companies and going, guys, you've got the pools of capital and you need these bits of technology that are being developed for your future business plan. Therefore, you have got to effectively replace the institutions and support them. That is your role. And we are sort of seeing it more and more. And it goes back to the pod point. EDF, there you go. Hey, the market can't do it. Fine, we'll do it. So there's a big sort of picture here, which I think is worth really thinking about. And that is, in a way, sadly, stock markets just aren't functioning correctly really at the moment. Governments have let them wither on the vine, which is a huge, huge mistake. But it's the big global corporates that basically can go and support these companies and go, we will replicate what the fund managers used to do. I think there's a really interesting angle there.
I'm absolutely with you. And the UK, if you look at UK technology, we've always been, as a nation, fantastic at inventing things. if you look at the inventions that have come out of the UK, and we've got a lot of companies, we've got companies here in tech that are rich in patents and IP, but have been unable to scale, achieve the scale capital. And you are spot on. It's the multinationals. Well, number one, have got the expertise to judge just how valuable the technology is, but two, have got the capital to invest in it. I mean, the Filtronic strategic investment that it got from Starlink was linked to orders from Starlink as well. You know, the way it's being structured, and yeah. So look, I'm absolutely with you on this. That it's that shift in capital availability, and yet with some irony, you know, if you look at the results for AJ Bell, I think it was a trading update from AJ Bell this morning. I'm sure a listener will correct me, but nonetheless, the growth in investment that they're seeing in their SIP platform. So people are putting their pension funds quite clearly in there, and it's growing, and it's the way that capital is distributed.
Yeah, but they're not necessarily putting it into, it'll all
No.
go into the Magnificent Seven or the
Exactly.
ETS or something, But I mean, talking of technology, I have my annual arm lunch tomorrow with Sir Robin Saxby and Jonathan Brooks and Tim Score. They obviously floated on April the 17th. So at this time of year, we have our annual get together. And lots of good tech ideas always come out of that. Trouble is, we tend to have a few bottles of wine as well, so I can never remember them the next day, Phil.
You'll take some notes this year, Andrew.
You take notes, forget it. Anyway, it'll be a great lunch, and I'm looking forward to seeing all the gang again. Actually, I do see them occasionally during the year anyway, because they are very smart cookies. Anyway, sorry, I interrupted you a bit there, Phil. Did you have some more companies you wanted to mention?
Well, I guess just one last one, and sticking with tech, and this is, we've seen lots of mixed news coming out of the automotive markets, and clearly there's a big, there's a shift. You opened up, we're talking about EVs and the move to EVs, but also, auto markets are economically sensitive as well. But nonetheless, there's one that's a consistent performance. This is AB Dynamics. Ticker is ABDP. Market cap now is £395 million. The shares, I think, are down about 6% over the last 12 months. You've probably got a chart there, Andrew, but they're up recently. I mean, a really interesting tech company, AB Dynamics. They develop safety assessment systems. So they've got systems that test. This is all new cars and the safety systems that are in the cars. And it's for all powertrains. It's across EV, hybrid, petrol, diesel. They've got 145 customers globally, major automotive manufacturers. And this is to test things like, it's for the what they call the NCAP system, which is New Car Assessment Program standards, and particularly evaluating ADAS systems, Advanced Driver Assist Systems. So they reported their interims, and they're seeing their revenue. And bear in mind, this is in a mixed auto market, but clearly the auto markets are spending on, new model development. Their interim revenues, were up by 11% to 58 million for the 6 months ending 28th of Feb. And that 11% jump in revenues saw profits rise by 21% to £10.8 million, and they expanded their operating margins. Always a big positive to see, to 18.6%. So closing net cash of £27.2 million, just down slightly, but they've made an acquisition of 3.5 million, and they've upped their interim dividend to 20%. So, I must admit, I'm a bit of a firm believer in companies that do well in mixed markets. When markets come really good, will do really well. But that was AB Dynamics. Very interesting.
Yeah. All right. Well, look, there's a few thoughts and missives and rants or whatever. That'll do for this week. And probably by next week, we should be sort of more back to normal, I guess. So back next week. Thanks.
All right. Chat then, Andrew.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.